Welcome to the Investors Real Estate Radio Show with Kevin Mills, where we dive into the dynamic world of real estate investing. Whether you're a seasoned investor or just getting started, join Kevin as he shares expert insights, tips, and strategies to help you navigate the market, build wealth, and achieve your financial goals. Tune in for actionable advice, inspiring success stories, and the latest trends in real estate, all designed to empower you on your investment journey.
Welcome back, everyone, to another exciting episode of the Investors Real Estate Radio Show. I'm your host, Kevin Mills, and today we have a great show lined up for you. Whether you're a seasoned investor or just dipping your toes into real estate investing, understanding your financing options is absolutely crucial. In today's episode, that is exactly what we're going to talk about. We're going to dive deep into financing strategies for real estate investments. I'm going to cover everything from traditional mortgages to more creative financing methods, ensuring that you have the knowledge you need to make informed decisions. Now, before I get started on the show, as many of you know, I also co-host a show with my good friend Bill Barnett called the Investor Guys Podcast. Now, we cover this topic multiple times in the Investor Guys Podcast. In fact, we just did a show on this exact topic. We just had a slightly different spin on it. I absolutely recommend you taking a look at it. You can find it at investorguyspodcast.com. That's the investorguyspodcast.com. Make sure you're watching shows over there too, because Bill and I talk a lot about the same things, but you get a different, slightly different view. Bill and I have pretty much the same scope on real estate, the same ideas, but different experiences and different thoughts, different ideas. So make sure you check that out, investorguyspodcast.com. Check out that show with my good buddy Bill Barnett and myself. So let's jump right in and start with overview of financing options. When it comes to financing real estate investments, there is no one size fits all solution. Different strategies work for different situations, and they work differently. Let's kick this all off by going over some of the most common financing strategies you're going to encounter in real estate investing. First up, we have traditional mortgages. These are the bread and butter of real estate financing. They come from defined terms, interest rates. They're offered by banks and financial institutes. You see them advertised on TV. If you bank and you actually go into the bank, you see posters up around. You probably get little flyers when you talk to the banker at the bank. These are your traditional financing that most homeowners are familiar with if they bought a house. It is a 30-year loan. Typically, as you could do 15, you could do 20. You're paying interest, you're paying principal. Not necessarily a good instrument for a real estate investor. You're probably only going to be able to do a few of these traditional loans, and start off with traditional loans. That's fine because it's what you understand. The bank, more than likely, once you get 10, they're not going to finance you anymore on a traditional loan. Many banks won't finance you if you've got more than 2 or 3 traditional loans. So keep that in mind when you're looking at your prospective properties. Have some backup ideas in place. But let's talk about this real quick, okay? The pros of a traditional loan is you're typically going to get a lower interest rate and you get longer repayment terms. Like I said, 30 years typically. The cons, qualification process can be very rigorous and it may take longer for you to secure the loan. So let's talk about lower interest rates. You're going to get a lower interest rate on a traditional mortgage than you will with an investor loan. However, if we're running the numbers, like I always say, run the numbers. If you're running the numbers and you're still making a profit, even paying that larger interest, then it's a deal worth doing, okay? Let's talk about the qualification process. Qualification process for a traditional loan, your down payment has to cover a certain portion in order to have equity in the property based upon what your income is, based upon what your debt ratio is. And again, if you're doing multiples of these, your debt ratio is going to go up. Each time you have one of these loans, your debt ratio is going to go up. So the banks have this box that they like to put everything into. It either fits in this box or it doesn't fit in that box. If it doesn't fit in the box, they're not interested in looking outside of the box to make it work for you, okay? So keep an option open on your properties. If you know it's a good deal, okay, keep an option for investment types of financing, which we're going to get to in a minute. Let's talk about hard money loans next, okay? Unlike traditional mortgages, hard money loans are typically offered by private investors or companies. They're known for being faster It'll help you get your funds a lot quicker. They do come with higher interest rates and shorter repayment periods, but they are perfect for fix and flips, rehab projects, or when you need to close quickly. They are not without their risks, though. Again, higher interest rates, shorter terms. If you are getting a fix and flip and you think you can get it done in 6 months, make sure you get it done in 6 months or less, because it's going to cost you even more if they allow you to continue with the loan. It's going to cost you even more after that 6 months, or they may say your loan is due after that 6 months and you have to go out and find additional financing or new financing on that project. So make sure you know what you're getting into with hard money loans, but it's absolutely a great product, and I use it all the time. And I know many other investors who like and swear by hard money loans. There are some investors who only use hard money loans because they've got a good relationship with their hard money lender, and they do all of their numbers based upon what that money is going to cost them for that investment. And again, if they're making a profit with it, it is absolutely worth using that as a strategy for their investment. Lastly, let's talk about private lending. This involves borrowing money from private individuals rather than institutions. We've heard of it before, OPM, other people's money. It's a flexible option that can be easier to negotiate terms, but finding reliable private lenders can be a challenge. A lot of us don't know people who have the ability to just write out a check for $100,000 or $50,000 or $150,000 to lend to us to use for our projects. And remember, when we're doing this, we also need to provide them with a return on their investment, just like they were from there. Nobody's just going to write you a check without being able to get something back. Maybe your mom, maybe your dad, but most other people are not going to be able to do that or want to do that. So let's dive into traditional mortgages a little more. Traditional mortgages, there are several types to consider. There's a fixed rate mortgage, which offers stability with a consistent interest rate throughout the entire life of the loan. So if you're getting a 15-year loan, your interest is going to be the same from the first day you got it to the last day, assuming you don't refinance it somewhere in the middle, which is actually going to be a different loan. If it's a 30-year loan, it's going to be the same on your first payment, your interest rate, not the same payment, but your interest rate is going to be the same all the way throughout the course of the loan until your very last payment. Your interest rate is going to stay fixed. That's why it's called a fixed rate loan. Adjustable rate mortgages can start lower, but they can fluctuate over time. And many times they do go up. If you got an adjustable rate mortgage a few years ago, when interest rates were low, now you are paying a lot more because our interest rates are up almost 7%. There's a formula, you may not be paying 7%, but there is a formula you're going to be paying more certainly than when you first got the loan on a first rate, an adjustable rate loan. Now, the reason you was, well, why wouldn't you just get a fixed rate loan versus a adjustable rate? Typically, there's multiple different reasons. One of them is points. A lot of times they charge fewer points for an adjustable rate loan. If you don't know what points are what they charge you when you get the loan. It's basically just fees that are thrown into the loan. You also qualify a little easier. There's some more exceptions to getting you qualified for a adjustable rate versus a fixed rate. So those are some of the reasons why people pick a adjustable rate versus a fixed rate. Most people, they're not pragmatists. They like to think a little bit more positive. They think, you know what, when interest rates go up, I'm going to have had a raise at work, I'll be able to cover it. It's not going to be a big deal. So a lot of times they go for that option versus trying to come up with the additional funds or whatever it is they need to make that fixed rate a more viable option for them when they're first purchasing that property. You also have conventional loans versus government-backed loans like FHA, VA, and USDA. Each has its own set of requirements and benefits, and they're all pretty much the same boilerplate, but there are some differences to each one of them, and it's a stack of different terms for each different loan. However, the basics for each one, you can figure out and know which one's going to be best for you. For example, an FHA loan is great for first-time home buyers with lower down payments. FHA can finance you on a home, not an investment property, on a home for as little as 3% down. Now, we talked about this before. If you are a first-time home buyer, if you're just getting started out in this, if you're a young person, go use your FHA first-time home buyer loan with a low down payment. I would pay as much as you can because you're going to be paying a higher interest rate based upon how much you're putting down. Use your FHA loan to buy a multifamily property up to 4 units. Live in one of those units. If you're young, if you're in college, live in one of those units, rent the other 3 units out. You have got income that is going to support your own unit. It's going to possibly even put money in your pocket. The bank is going to look at that income as additional income for allowing you to qualify for that loan. You may not want to live in a fourplex for the rest of your life, but as long as you live there for 5 years, then you can go ahead and move out. You can keep that property as an investment property, and it no longer affects your loan as far as a first-time home buyer and first-time home buyer requirements under, say, an FHA loan. And you've got your first investment property that you have a very sentimental attachment to because you lived in it for 5 years. And again, perfect for college students. Parents, consider this when you send your children off to college. If they're going to be going to that same college for 3 or 4 years, purchase that property, help them purchase that property, let them have a place to live, let them have some responsibility, taking care of that property. And again, set them off with a good investment to start their portfolio off with, as well as a great education. VA loans offer significant advantages to veterans. When applying, lenders will absolutely look at your credit score, your income, and your debt to income ratio. So it's essential that you have all of your documents in order. Don't go in there and wing it. Make sure you know what your credit is. Make sure you know what your income is going to show. Make sure you know what your debt to income ratio is. And your debt to income ratio is basically how much debt do I have? How much do I owe for a car payment? How much do I owe on other properties? How much do I owe for my credit cards versus how much money do I make? If your debt ratio is high, pay it down before you go get a house. Pay down that car note, pay down those credit card notes, especially credit card notes. Pay them down, and that way you're going to qualify a lot more easily due to that debt to income ratio. So it's essentially have all your documents in order, and of course, securing the best interest rate can save you thousands, even tens of thousands, maybe even hundreds of thousands, depending upon the price of the home over the life of the loan. We're going to discuss some strategies that are going to help you do just that, but we'll be back in just a second. We're going to take a break.
Awaken your potential and harness the strengths of your inner self. Online courses that you complete at your own pace. Set and achieve all of your goals. Packed with an ever-growing catalog of information, resources, learning programs, weekly recorded coaching sessions, podcast, posts and more to keep you on track for your best life. Because the only person who can guarantee your success is you. www.reallykevin.com.
Absolution X, limited editions, lifestyle apparel like none other. Get yours today at absolutionx.com.
Live the resort lifestyle every day with Cayman K. The perfect pieces for every wardrobe. Shop the entire Cayman K collection and find your favorites. Find all our styles at CaymanK.com.
All right, we are back, and we are going to talk about hard money loans in greater detail. So our focus for this segment is hard money loans. They are particularly useful when time is of the essence. If you've got a great property and you already have a regular mortgage or whatever else, or so many different scenarios for having a hard money loan. We'll discuss a few of those in those segments, but these are great if you have a short time frame in order to get this property. This is not what you're going to want to use for the property you're going to live in. This is an investment loan. This is an investor's loan. Okay. If you're looking at a competitive market and you need to get something bought up before somebody else has a better offer on it, or before somebody else makes an offer on it and snatches it up, use a hard money loan. If you've got a fix and flip scenario, these are great for fix and flip scenario. However, you're going to be paying higher interest rates and fees, so you need to be careful that you understand what you're getting into. Now, one of the things that I'm always talking about with hard money loans is you need to have your numbers together. I'll tell you numbers all the time. Make sure you have your numbers together because you're going to have to give a presentation. It's not going to be a big in-depth PowerPoint presentation or anything else, but you need to have your numbers ready to go to present to the hard money lender. They're going to review your numbers. How much is it going to be for you to acquire this property? How much are you putting into it? How much is it going to be to fix this property? What kind of time frame are you going to fix this property in? How much are you going to sell this property for? And when are you going to sell this property? Those numbers are going to be reviewed by somebody else who does this day in and day out, because you are one investor. They're dealing with 20, 30, 40 or more investors every single day. And they're writing multiple loans every single day. So looking at these numbers gives you a second set of eyes that know what they're talking about. You may not agree with them. Maybe you see something that they don't. If that's the situation, then explain it to them, help them see what it is that they're missing. But you have professionals that run these numbers day in and day out. And they are going to come back and they're going to say, I think this is a great deal, but I think you should do this. Or this is a great deal, let's do this. Or I think this deal is not as good as you think it is. I think you need to take a look at this. I think you need to take a look at that. You need to consider this. And you need to consider that. And perhaps once all that happens, you'll realize that it might not be the deal that you thought it was. A lot of us get emotional about offers that we're making. We see something and we get fixated on it, and we have all these pie in the sky ideas that are not necessarily realistic. They're emotional. By putting it in front of a third party, and that's what a lot of these hard money lenders are for us, is a third party to review these numbers and say, you know what? I don't think you're seeing this realistically. I think this is maybe coming from an emotional standpoint. I think you need to step back, run the numbers, and get in touch with reality on this particular property. Finding a reputable hard money lender is crucial, but there are so many of them out there. Just do a little bit of homework. You want someone who's transparent about their terms, that has a solid reputation. Typical costs include higher interest rates, higher points, and a lower loan to value ratio, which will affect your overall financing strategy. They will probably, and I say this, not all hard money lenders are like this. I know hard money lenders that will do 80%. I know hard money lenders that will do 100% of loan to value. A lot of times they won't do 80% of value. They'll do 80% of what the actual loan is. Some of them will do 60% of what your actual loan is. So you're going to have to put in 40%. Each hard money lender is different. Your terms are going to get better. The longer you do this, the more you use that lender. And once you do a few deals with that lender and you cash them out and everything goes smoothly like it's supposed to, they're going to be more excited about doing more projects with you. And they will let you know on your next ones, you know what? I think we can do a better term for this one. I think we can get you this. I think we can get you that. They want to build a relationship. If you are winning with them, they want you to continue to win with them and keep bringing that business back versus going to look somewhere else for someone else. If they have a winning client that continues to pay their loans and put money in their pocket, which is exactly what you're doing when you fulfill your loan agreement, they're going to want to keep working with you, and they're going to make it easier because you're less of a risk. So that said, let's go into private lending. Private lending, it really, when we think about it, all of these are other people's money strategies. This is not money coming out of our pockets. This is money that other people are giving us. Yes, we may be coming up with a down payment. We will be coming up with 10%, 1%, 3% on our FHA loan. It is some money out of our pocket, but the majority of the money is coming out of somebody else's pocket. So it's really OPM no matter how you look at it. For real estate purposes and for investors talk about, they talk about private lending as being somebody that is non-institutional. So somebody that's not a business or a company that's in necessarily the terms of making loans, the business of making loans. That's not to say that there might not be a neighborhood Shylock or something who does make loans and has an interest rate on it that you might want to go to. I'm not suggesting you go to a Shylock. For those of you who don't know what a Shylock is, get on the internet and do a little bit of research. Just a joke. There are people, aunts, uncles, family members, friends, they do like to invest in people that they know. That is their strategy for investment. That is what they like to put their savings into to grow their savings. If you know people like that, sit down with them, go over the numbers, make sure you're looking at realistic strategic numbers. Same as a hard money lender, realize that once you've done a number of great deals with these people, they're going to be excited about continuing to give you money and invest with you because they know that you are growing their money for you. Now, a lot of people are like, well, why would I go get somebody else's money and do all the work and give them the investment? Because you know what? Without their money, you're not going to be able to do these deals. Without their money, you're not going to be able to make this money. You're making money on your work, but somebody else's investment. So would you rather make money on your work and somebody else's investment, or not make money at all because you don't have the investment, so you can't put in the work, or make money on your work and your investment, but it's going to be less because it's your money that is up and it's your money that's risked for that period of time? Private lending is another investing avenue. It offers flexibility in terms and conditions, which can be particularly appealing for unique or non-traditional investments. Networking is key because the more people you know, the more you're going to know people who are able to or interested or want to or can refer you to somebody who can write you a check for your investment needs. You can do that through real estate clubs, online platforms, your own website, personal connections, or finding the right private lender that works with other lenders. A lot of times there are brokers. I know a lot of brokers who are constantly emailing me. They have lenders that they work with that are looking for investments. That individual gets a broker fee by placing them with me in my investments. These people know that I have, excuse me as I knock over my drink, that I have winning strategies. And they know that they can confidently refer their investors to me to invest their money, and they're going to get a return, and it's going to be secured by real estate. So negotiating, focus on creating a win-win situation. Discuss interest rates, repayment schedules, and any collateral that is going to be required. Build a strong relationship with your lender, and go for the long term with all of these. Make sure that when you start, you plan on building a relationship and having these people do multiple different projects with you. Now, stepping into this, you might think this is great, and you might find out that it's not later on. Find somebody else. If everything goes well on your side, everything goes well on their side, why look for somebody else? Why reinvent the wheel? Take your business to these people and continue to do business with them until something better comes along, if it comes along. As long as the numbers work, as long as you're making a profit, as long as you're putting money in your pocket, do the numbers. It works. We'll be back and we're going to talk about creative financing strategies when we do.
Live the resort lifestyle every day with Cayman K. The perfect pieces for every wardrobe. Shop the entire Cayman K collection and find your favorites. Find all our styles at CaymanK.com.
ReallyKevin.com. Weekly recorded coaching sessions. Learn, grow, find resources, opportunities, and more. You'll find it all at ReallyKevin.com.
Get ready for power, for success, for solutions and answers. It's all in one place. www.reallykevin.com. Education, opportunities, coaching, and so much more.
All right, we are back. Final segment of our show. We're going to talk about creative financing strategies. So let's talk about some of the creative financing strategies that are out there that investors like us can take advantage of. Seller financing is one option, and that is where the seller acts as a lender. A lot of us don't think that there are that many deals out there. I can tell you there absolutely are. Maybe not right now where it is a seller's market, but it's changing. We're getting more into a buyer's market. So if a seller really wants to get out of property, they may absolutely be interested in offer seller financing. A lot of real estate deals that we do through the real estate company that I have, we have a lot of times where sellers will do the financing. Sellers will carry the note for a certain period of time before they expect you to get a loan and cash them out of the loan. That could be a year, it could be 3 years. Typically, it's around 5 to 7. They carry the note, they make the interest on it, which is almost pure profit those first few years. They're making money on it. They already own the property. They don't have anything that's risked. They have somebody who's either going to buy the property, cash them out, which is what they're trying to do anyway, or they're going to get the property back and they're going to turn around and they're going to sell it, but it's not costing them anything in that process. You're paying them their monthly payments. If you find the right person, and it's not that difficult, it's not as hard as you think, you can find someone who will do seller financing. I know people right now who have investment properties that they acquired through seller financing. I know people right now who are living in properties that are seller financing properties. Again, this is where the seller is the bank. Work out the terms with them, whatever it is that works for them, whatever it works for you. Remember, you're doing this based upon the numbers. The numbers have to work for you. It can be a great way to close deals quickly, and you get very flexible terms. Another strategy are lease options and rent-to-own agreements. As an investor, I personally would prefer to offer lease options and rent to own as to getting into lease option and rent to own as far as acquiring the properties. However, if you're going to do this as a short term, if you're going to go into let me give you an example. There are properties, commercial properties that I started off as a tenant. I leased it for office space or whatever else. I liked the property that I was in, and I offered to maybe I knew that they wanted to get out of the property, or maybe they were even selling the property. I offered to start converting my lease into a lease slash down payment. So while I was leasing the property, I was giving them additional money, even taking over additional spaces in the same complex and subleasing them out, but providing money to the seller of the property to secure my option to purchase the property. So it was a rent to own, lease to own type of thing, where I was giving them a down payment. Now, if I defaulted, if I decided I didn't want to buy the property, if I decided I wasn't interested, couldn't do it, whatever, all of that money was forfeit. That's the way I set it up. That lets them know that I'm serious. That lets them know that this is something that we're going to get done. This also encourages them to want to do the deal, because they're like, you know what, worst case scenario, I give this guy's money and I'm still selling my property, but I have tenants in my property in the process. So a rent to own, lease to own, pretty much the same thing. But like I said, that's the only way I can really see using that as a strategy to acquire properties. Once we have the properties, if we have a property we'd like to get a little bit more money out of, a rent to own, lease to own, great way to get people in there, great way to get more income. If we're planning on selling this property anyway, great way to maybe wait until it becomes more of a seller's market. And if our tenants back out, they decide they don't want it, then we've got a property we can turn around and sell. If they decide they don't want it, then we have a property that has a rental history. We know what we can expect to receive from this property on rental history. The people in the neighborhood are familiar with it as a rental. It can be a win-win situation if you do it the right way. So think of it as basically rental income on your property when you're doing that type of a scenario. Another thing we need to look at is partnerships and joint ventures. They can be very powerful tools as well. They allow you to pool resources, share risk, and leverage different experiences. However, it's important to structure these partnerships carefully and consider all legal and financial implications. Now, I was doing a show earlier this week with my good buddy, Bill Barnett, who we talked about earlier. These are things we were talking about, not just partnerships and joint ventures, but strategic partnerships. A lot of times when you're trying to find financing for particular projects, entering into the right strategic partnership, it may not be with the money person. We may still need a money partner. But in entering with the right strategic partner, perhaps it's a property management company, perhaps it's somebody else. Entering into a strategic partnership with these individuals allows us to have a better presentation, to look better on paper, to be better in reality when we're trying to find that money lender. Make sure we structure our partnerships carefully and make sure we consider our legal and financial ramifications to all of this. Because again, these are partners. Make sure we know what we expect from the partners. Make sure we know what they expect from us. Make sure we know what the returns are and how those are going to be paid out. It could just be, for example, a property management company, in which case we're either paying them a flat fee to manage the property or we're giving them a percentage of the gross rents that are coming in. It could be another type of partnership. And again, however that works for both parties and works best to get you to where you need to be is a strategy you need to go to. So we're to a part of our show where we talk about Q&A. And some of the questions that we've gotten in the past about some of these topics that we're talking about right now. But I also want to tell you, well, I've got you. Investors Real Estate Radio. InvestorsRealEstateRadio.com is our website. You can send me an email to Kevin at Investors Real Estate Radio. Ask me questions. At some point, we're going to get to them. We may just get to them when we get to them on any particular show. We may just answer your questions. However, send me questions because that gives me an idea of the types of shows we need to go through. And what is crazy that I've noticed over the 20 plus years of doing this is questions seem to be along a vein. So questions that I get in 1 month will, for some reason, be very, very similar. And they'll be different to questions I get in another month, which will be similar to each other. So I don't know if you guys are watching the same podcast, the same videos, or the same TV shows, or you guys are part of the same real estate investing groups or whatever it is, but keep those questions coming in. And again, I can try to tailor shows to address those questions that you have. So we have great questions that come in. We do have a social media that we need to spend a little bit more time on, and we will absolutely get to that. I will let you know what those are as we get that social media back up. We have it. We just haven't been spending enough time on it. But I promise you, with this new season that we're getting into, I absolutely will. And I will help you as best I can with your questions on financing and everything else. Just get them to us. Again, Kevin, Investors Real Estate Radio. So it's InvestorsRealEstateRadio.com. There's no show there. Okay. There's a show right here. So let's wrap it up and look at some real life examples of successful investing using financing strategies. And I'll share some of mine. We'll analyze what made these deals work and challenges faced and lessons learned. Understanding these case studies will help you apply similar strategies to our own investments. And when I say that, I want you to not just listen to my examples. I want you to go out, see what other people have done. If you don't belong to a real estate networking group or a real estate investors club, get out there, talk to other people, find out what they've been doing. Even if you are a long-term investor, get out there because this is a great way to get the blood flowing, to get the brain back into gear, to get motivated, to do whatever else it is by seeing other people going out there. It's also a great way for you to help people who have questions who you may have the answers for. Now, I can't even begin to tell you how many different times I have used hard money, how many times I've used other types of financing strategies. So my case study here is going to be basically another lesson, all right? And I'm going to make it as short and easy as possible. If you don't borrow money to do your real estate investing, you are going to be very limited. If you are only borrowing money if you're only spending money that you have, then you're very limited with what you have. I've done shows. One of them was 30,000 plus ROI on somebody else's money, and you can do it too. Look it up. Another one is 50K to millionaire. How you can invest $50 million and you can do it with somebody else's money. And within 10 years or less, you could be earning $1 million a year cash flow. $1 million is $1 million cash in your pocket pre-tax, and have multiple millions of dollars worth of assets in your portfolio just from $50,000. And you can get that $50,000 from somebody else. You can start with that $50,000 that's not your money. Again, if you're waiting to invest your own money, it's going to take you longer to do. So a lot of us start off investing our own money, and that's fine. If you got it, go ahead and do that. Don't let a lack of money stop you from getting started. Go out, find good deals, run the numbers, and start finding the money you need to do these deals. Donald Trump, like him, don't like him, doesn't matter. He would not be the person he is if he did not borrow money to purchase the acquisitions that he has. If he did not borrow money to build the empire that he has, he would not have the empire that he has. Yes, his father had a lot of money. Yes, his father gave him money and staked him to start, but his father didn't lend him the money that he needed to buy all these additional assets that he has. He went to the banks. He put his hat in his hand many times and went to the banks and asked for money. And if he hadn't, he would not have the empire that he has now. And it's not just him, Elon Musk, Jeff Bezos, others. They understand that it takes money to make money, and you have to use somebody else's money because you may not have your own. I hear so many people say, well, it takes money to make money. I don't have any money, so I can't make any money. You know what? You don't have to have your own money. Use other people's money. Use investment to get your investment strategy started so that you're making money. Your return on investment using somebody else's money is significantly more than if you're investing your own money. So that is going to be my case study right there. I would not be a successful investor if I did not go out and borrow money in order to make investments. That is it. Bottom line, across the board, for every single investment that I've done that I have not used my own money for, which is very, very few. And the only reason I use my own money for investment is if it's a passion project. If it is something that I want to have, a particular property that I want to have, I need to buy it quickly, and I know I'm going to keep it forever, and I'm going to put tenants in it, or I'm going to use it for Airbnb rental or something like that, then I will go ahead and I will put my own money into it. I'll pay cash for it. And that money I have to pay cash for it comes from investments that I invested in using other people's money. Before we sign off, let's talk about choosing the right financing strategy for your needs. So consider your investment goals, risk tolerance, and credit worthiness. Very important. Know your credit. Know the value you carry in credit and in income before you go for financing for anything. It's important to match your financing strategy with the type of investment that you're pursuing. Again, hard money might suck for you, but it might be the answer to getting the deal done and putting money in your pockets. Stay informed, very crucial. Keep up with market trends and financing options. Know what the interest rates are. Don't underestimate the power of networking and learning. We can always learn. I sit here, I do a radio show, I do a podcast, I do multiple different speaking engagements, everything else. But you know what? There are things for me to learn still. There are things for me to try still. And I'm looking forward to it. Bill and I had this conversation the other day. We're not going to be investors until the day they put us into the ground. And when they put us into the ground, we are still going to own that plot of land. That's going to be ours. It's something that is in our blood. If it's in your blood, make sure you understand how to make it work for you, because the more you make it work for you, the happier you're going to be, the more excited you're going to be, the more successful you are going to be. That's all we have time for. We've covered a lot of ground, from traditional mortgages to creative financing strategies. Remember, the right financing can make or break your deal. So take the time you need to evaluate your options and seek professional advice. Again, feel free to send us an email. Be sure to tune in next week, where we're going to be discussing even more great real estate strategies. And you want to know what we're talking about, so don't miss it. As always, I'm Kevin Mills. I want to thank each and every one of you for being here and listening. If you want to continue the conversation, follow us on social media or visit our website, which is InvestorsRealEstateRadio.com. Remember, no show. We are the Investors Real Estate Radio Show, but our website is InvestorsRealEstateRadio.com because I don't want anybody to have to type out too many letters while they're looking for us. Till next time, happy investing. I'll see you soon.
Thank you for tuning in to the Investors Real Estate Radio Show with Kevin Mills. We hope you gained valuable insights and are inspired to take your real estate investments to the next level. Remember, success in real estate is within your reach, and with the right knowledge and determination, you can achieve your financial dreams. Stay connected with us for more expert advice and resources, and until next time, keep investing with confidence.